I think it's completely portfolio dependent and asset dependent. In this particular case, we started with a very imperfect set of information, based on the very imperfect market, where pricing in general in 2008 and 2009, pricing of real estate was extremely difficult, and just assessing the strength of the co-lenders and the strength of the borrowers was extremely difficult. So it was a very unscientific sort of approach to what would be a possible min or max. So the outcome is then a factor of what work has been done since that point, what was the actual starting situation about, and how have external markets influenced it, both in terms of demand for property, whether it's commercial or residential, and the general health of the currencies that those assets are exposed to, etc. So I think there is no way to generalize that and extrapolate that conclusion to any other conclusion except for something that's almost identical. So we see portfolios exchanging hands on the extreme end in Dublin and starting in Spain on a very, very low level, where we have a lot of land banks and undeveloped assets where you are trading at maybe 15p. How much will they actually recover is impossible to say, basically. So it's very difficult to generalize. I think that's a short answer.
I think it's very useful if you have a tailwind, and if the markets improve, surely pricing is going to improve as well. But I think the point for the banks is not just recovery value, it's a balancing act between recovery value and the cost of capital, actually carrying that property in the balance sheet. I think there's a balancing point whereby you just take the losses as they are at the moment, just to release your capital and move on and lighten up your balance sheet. And I think that's, at the end of the day, what the banks are looking at.